All right, getting out of United Health. We can talk all day about the markets, but there's nothing like going towards, of course, the experts. So coming up, Thomas Hayes, chairman and managing member of Great Hill Capital. And I want to give you guys a little bit of some insight that you guys can check out and learn from my man, Thomas. I appreciate when he always comes on. And one of the things that he has this great site that you guys can check out, hedgefundtips.com. Let's go ahead and bring Thomas on. All right, how we doing, Tom? It's good to have you back on the show. Welcome back.
Doing great, Mitch. Great to be with you. I remember the last time I was on was under much different conditions. It was October 13th. The S&P was at 34.91. And you kind of cornered me at the end of the interview and you said, Tom, where are we going to be by the end of the year? And it was, I think the Dow was down like 500 or 700 points that day. I said, Mitch, that's not my game, but I'll give you a range. I think we're going to be at 4,100 to 4,250 by the end of the year. So we're getting close, and I stand behind that, and things are moving in the right direction. But it wasn't an easy call back then.
Yeah, it never is easy, right? I always say when we're looking out in time, I mean, it's just going to be more perspective on the macro headwinds. Are those going to be affecting us, right? And always, it's just a good perspective just to have. And then, like always, we got to look towards the price action. It looks like we've had that kind of rally. Looks like some of the bulls started getting control. We got some good supporting economic data. Now, it needs to continue. Now, from China right now, we're getting mixed signals. It seems like we're getting some news or noise, whichever it may be. What do you see going on here right now, Tom?
Yeah, so I spend a lot of time on China. I do think that's going to be one of the best trades in the coming years. And the most important reason why is the dollar. I know I've been on with you a couple times. I say, watch the dollar, watch the dollar, watch the dollar. Well, sure enough, in the last couple of months, the dollar started rolling over materially. And China and emerging markets have started to get a small bid. I think you're going to see that follow through as we turn the calendar. As far as the protests, I think the protests are really a positive situation, because if you look at the Hang Seng Index and the Shanghai Composite, I went back to April 15th of 1989 to June 4th of 1989, which were the protests and then the Tiananmen Square incident. The next 4 years, from 1990 to 1994, the Hang Seng was up 380 some odd percent, and the Shanghai Composite was up 1,100%. So for people saying this is the beginning of the end, I think this is the beginning of the beginning. In this case, it does seem now that Xi has secured his power domestically that he'll be somewhat more responsive to these protests, and we saw as much this morning. They started coming out and we started to see leakage where they were preparing press conferences to say the current variant is more like the seasonal flu. Not many people are dying. They're also now focused on vaccinating the elderly, which basically are sending the signals that they want to get the economy open, and they got to do a little bit of ignoring this and declare victory. They can say, look, when the variants were bad, we saved millions of lives, pat on our back. Now that it's like the flu, we have to get on with it. And those who are at risk, get your vaccinations. They also have the new nasal vaccine, that inhalable vaccine. That's a positive. So I think what you're going to see in coming weeks is some more press releases that things are moving back to normal. There was one small region I saw this morning that lifted some restrictions effective midnight. So they're actually currently out of lockdown. And I think you're going to see more and more of that to come. There was a modest downtick in cases, but that's kind of immaterial at this point. I think the government recognizes they've largely lost control. And if they don't kind of bend here, they're going to break.
Are you concerned with maybe potential problems continuing from kind of the tech war that I'm kind of seeing out there? It seems like, of course, deglobalization seems to be a trend that we're starting to lean towards here and other countries. So do you feel that there's going to be a continued kind of tech battle there?
Well, in the sense that some of our chip providers will not be able to do business in China, there's certainly a risk of that. But I think, as we look forward, I'm starting to look for more opportunities outside the U.S. that will benefit from the falling dollar. And most of the large tech companies, I like Alibaba. That's a long-term investment, longer than I had anticipated. But that thing is gonna work out over the next few years. So they're less dependent on the U.S. supplies. They have their cloud business, they have their retail business, and the minute that the government pivots and blinks, which it may have been last night, but certainly we'll see for sure in coming weeks, these businesses are going to do exceptionally well, provided the dollar stays weak and we start to see flows into emerging markets. You look at K-Web was down 80%. I mean, it'd be like saying, if you could buy the Dow Jones in 1932, would you be interested after it crashed 80, 90%? If you didn't buy, you lost generational wealth opportunities. I think the same is the case for the highest quality Chinese businesses. And even if the government continues to screw things up in China as they have for the last 12 to 18 months, consistently, repeatedly, against their own self-interest, eventually the virus just dies out on its own, as it did in 1918 to 1920 with the Spanish flu, when there were no vaccines. Eventually, it just runs out of hosts. So we're very constructive on that side. As far as U.S. tech, I think you broach a very important point, Mitch. U.S. managers, one of the data points I look at a lot is the Bank of America Global Fund Manager Survey. And one key tidbit this month that came out, which was about a week and a half ago, is that managers are the most underweight tech since 2008. So everyone's gotten on one side of the boat. No one wanted energy. No one wanted banks in 2020. After they're up, 200, 300%, everyone wants them. And now no one wants tech. Well, if you had bought tech the last 4 times that managers were this underweight, you did exceptionally well, whether that was October 2008, August 2006, August 2004, or October 2002. So we do see a lot of specific discrete opportunity in that group.
All right. And the next area that I want to go to is, it seems like, we're starting to see these casino stocks that have Macau exposure getting a nice lift. We saw the Macau licenses going through. How do you feel this is going to play out? Because it seems like, of course, if it's going to be more of that lockdown situation, might be a situation to see a turnaround. But if you feel that we're getting towards that reopening, do we have an opportunity with some of these casino plays?
No question. I think if you look at Las Vegas Sands, which is now mostly Macau-based business, if you look at Wynn, mostly Macau-based business, these are doubles and triples over the next 3 years. So I know your audience likes to do things very, very short term, some of them, but if you just step back, and even if it's a pocket of your portfolio, be a little longer term, be willing to double and triple your money with no effort. And that's really, what these opportunities are. I think when you look at LVS, even we own Melco Crown, which is more of a Macau-based provider. These things, the Asian culture is gambling in nature, and the demand for these is going to come back in spades. You talk about pent-up demand. We saw the travel numbers for Thanksgiving this year finally much higher than pre-pandemic levels. Well, wait till you see the gambling numbers over the next 12 to 24 months in Macau and China, as people finally get out of lockdown and they want to get back to their normal lives. So these are no-brainers. The licenses were the last piece. Now we'll wait for them to come out and say, wait a second, COVID is like, this variant is like the flu. Go about your business, take your vaccine, wear your mask, and these things could really make a lot of money for investors over the next couple of years.
Well, how did you see the holiday season starting off? It looks like we had a decent Thanksgiving and Black Friday. Of course, another good Cyber Monday. Do you feel this will continue in the holiday season?
Yeah, record Black Friday sales up 2.1%. I do think the consumer is relatively strong. The Fed's doing everything to slow growth, and I think that's why we're in a holding pattern. Obviously, today we're waiting for Powell to speak tomorrow. We're waiting for the PCE inflation numbers. We're waiting for the jobs report on Friday, and then the CPI the day before the next Fed meeting. So that's kind of a governor. But I think on balance, I can't go anywhere and restaurants aren't packed. So I think that people, maybe they're running out of savings, but the average homeowner has $207,000 record home equity across the country. That's not just on the coast. So when you think about that wealth effect, when you think about their savings rates are still much higher, yes, they're coming down. I think people have spent 2 years of making sacrifices, and they're like, I just want to live my life, and I'll deal with the consequences later. And I think we're going to see more of that going into next year. The key will be when unemployment starts to tick up above 4 and close to 5. That'll probably be the peak for this cycle. That's when we'll see a little bit of pullback. But the market is a discounting mechanism. And I think the key thing that you want to keep in mind, Mitch, is you hear a lot of analysts out there saying, well, the market can have bottomed because earnings are going to come down another 10 or 20% from here. And there's consensus around that. And you have all these people calling triple break putts. We're going to rally into we're down, and then we're going to rally into year end, and then we're going to go down, and then we're going to go up on April 1st. And it's the most ridiculous nonsense that you've ever heard. If you look at the last number of cycles, basically, whether it was 1957, 1974, 1982, 1990, 2009, or 2020, the stock market bottoms 6 to 12 months before earnings bottom. So if earnings are coming down another 10 or 20% in the next 6 months, that's not necessarily a reason to sell. That's a reason to potentially start adding high quality businesses that have been marked down, because in every single case, by the time earnings had actually bottomed, in those 6 instances, the stock market, the S&P 500, had recovered most, if not all of the losses, and in some cases was at new highs. So that's just the way it works. And what people can't get their head around is, well, how's that going to work? If earnings are at 230 for next year and they come down to 210, and we're back at 4,800 or 5,000, you're talking a 25 times, 30 times multiple. But that is how markets always bottom, with a high multiple, and then they'll start to discount 2024 earnings, which will be much better. And that's what it's done. So we've had the 25% crash on the basis of what's to come. And then we'll have the recovery and beyond on the basis of looking out to 2024 once we turn the calendar.
Now, of course, it seems like I'm wondering about a relationship here. Of course, the Fed rate hikes with the dollar. Seems like they've been running side by side. Now, do you feel that this trend is going to continue, or do you feel like it's going to split here, especially as the Fed has been said to potentially start slowing down the pace?
Well, just like the equity markets are a discounting mechanism, I think the dollar is starting to sniff that out. I think consensus is now 50 basis points in December. I mean, one thing that I do think 75 is off the table, but one thing I will say that no one's talking about is the possibility of 25, albeit it's extremely low probability. But if you got extremely low inflation prints tomorrow, bad news is good news, jobs report on Friday, meaning a lot less jobs than expected, and a really low CPI number the day before, it's not outside the realm of possibility they could only go 25. The market would be shocked by that. But let's stick with consensus is at 50, and then the following meeting is 50 or 25, and then we're basically pause, and they'll stay at those levels for a considerable amount of time. That sets the stage. That move out of the four emergency rate hikes of 75 basis points into 50 and 25. Paul Volcker, it's very interesting. Everyone's worried about Powell because his hero is Paul Volcker, and he uses these famous 3 words, which was the title of Volcker's book, which was "keep at it." Okay, so he's going to keep at it, and he's going to put as many people out of work as possible and not take into account the lagged effect. Although we saw in the minutes, they're now discussing the lagged effect of the policy. In October of 1982, Volcker made a simple change while inflation was still near 7%, and he shifted from "keep at it" to the words "may change tactics," may shift tactics. And the moment those 3 words came out of his mouth, within 4 months, 100% of the losses have been erased. And within the next year, we were 20 some odd percent above new highs. So you have to keep in mind, like, a little shift in tone could have a lot of impact on the market, because as we continue to talk about, the market is a discounting mechanism. So I'd watch the language. I think I'm with you. I think in the short term, he's going to keep that hawkish talk. He tends to overshoot on both sides. You were around in 2018 and saw the train wreck he caused in December 2018. So I'm not counting on him to deliver any presents under the tree. But I think the market will start to sniff out as we move down, and the U.S. dollar once it sees that rate of change move from 75 to 50, knowing we're going to 25 and then pause, that parabolic move is getting crushed, and I think it's going to continue to roll over.
Definitely something that we'll be looking for. Will we get some actual disinflation, right? I mean, that could definitely help, right? Deflation is what we're looking for. Dollar coming down could definitely help that. Now, I did hear about, of course, today Speaker Pelosi saying that they're looking to have a bill down for trying to deal with the rail disputes. How do you feel about the situation? Is it going to have any kind of lasting effects here in the stock market?
I doubt it. I think, look, this is a Democratic administration. You still have a Democratic Congress. They'll figure out a way to get it resolved. This is supposed to be a pro-union administration, so if they can't get it done, who can? I wouldn't lose a lot of sleep over that. I think that gets done before Christmas, if not sooner.
All right, last thing, saved the best for last, so definitely smash the like button. The latest on oil from Tom. I want to know, what do you see out there? It seems like oil is just hanging out here in the 70s. Can these oil stocks hang on with oil in the 70s?
Well, I'll tell you, I think the last time or so, you had me on talking about oil. Look, I was bullish on oil in 2020. We shaved off earlier this year. Maybe a little too early, but we made a lot of money. We didn't want to be pigs. Bulls make money, bears make money, pigs get slaughtered. I'm less interested. I would say if the equities come down materially, we consider reloading for the next 3-year trend. But at these levels, we're a lot less interested. We like to buy things when they're dislocated. Look, I could buy things like Warren Buffett. Taiwan Semiconductor got cut in half. While everyone was sucking their thumbs waiting for China to invade Taiwan, Buffett swooped in, was greedy when other people were fearful, and he bought $4 billion of Taiwan Semiconductor. Amazon's cut in half, 50%. You think that business is going to do better or worse 5 years from now? Meta's down 75%. Disney's down 55%. Emerging markets are down 40%. K-Web's down 80%. I mean, take your pick. Wall Street's the only place in the world when they hold a clearance sale, no one shows up. And I got to tell you, Cyber Monday may be over, but in terms of the stock market, there's still a lot of opportunity.
Well, thank you like always, Tom Hayes. We'll definitely have you back on to maybe have a little bit of an outlook into 2023. Always love your insight. Appreciate you guys. And definitely check out the hedgefundtips.com. Appreciate you, Tom.
Thanks, Mitch.
Have a good one.